Stuck in a system that just ain't right. Gonna tear it down, gonna start a fight. Anarchy and numbers is my game. I'm the investor with no shame. Greed and corruption, that's the name of the game they play. It's all a shame. I won't play by their rules, I won't comply. Anarchy's the way. It's time to fly. I'll burn down the walls and break the chains, shatter the illusion.
And here we go. Welcome. I am Matt. This is the Anarchist Investor, live coming at you every Monday through Friday at 12 Eastern, talking about contrarian investment, markets, the economy, trying to help you protect and grow your money without it getting stolen by some dirty banksters. A reminder, help me with the algo. Give me a like, a subscribe, and upvote, a follow, or a share. And that will go a long way to getting this information in front of people that it could help. And that's ultimately what I want to do here. So let me pull the banner down and let me pull up what we were looking at. Bitcoin, it's popping off, people. It's going. This is the day. No, I'm kidding. No, Bitcoin's caught a little bit of a bid here along with the rest of the market. And we'll get into why here in a minute. But I wanted to use this opportunity to hawk what I'm going to be writing about later on in the week. And in fact, what I did write about, I'm drafting out and will probably be released on Friday on the Substack, is I scrounged around the house. I found some money that was, fiat coins that I could get rid of. And I got some other stuff that I sold. And there's some things back here. I got a list on eBay, all kinds of the stuff, right? I'm looking under couch cushions, literally, because what I'm trying to do is I'm trying to buy silver and I'm trying to buy gold and silver backed crypto via Kinesis. At least I'm trying to try out, or I'm attempting to try out Kinesis. I can give you a quick screen share here. Like I threw some Bitcoin into it just to get the account going. But if I pull up the dashboard here, you see there's just a little bit of Bitcoin sitting in the account. But I'm going to be doing a full walkthrough of my experience signing up for Kinesis, what it can be used for, what some of the limitations are. There are some limitations if you are a U.S. resident. But that's what I've been doing the last couple of days. I've been literally like getting coins and things that I've had waiting to be listed on Facebook Marketplace and all kinds of other stuff. And it just so happens that to get money into Kinesis, I had to put some extra money into a crypto. Didn't have to be any specific crypto, but so I put it into Bitcoin and I moved it over. And surprise, surprise, I get a nice little 5% pop on my crypto just moving it in and going through that process. So it's a nice little cherry on top there for that part of the process. But what I do want to talk about today is something that is causing the markets to move, at least for the day. And it's feeding into something that has been growing. And I wrote an article about this and I did a video about it. I think we are in the final rally. Not the final rally ever. Markets a lot of times can get inflated to higher heights. And in fact, I would make the argument that since 2008, most of the new all-time highs in the market have been the result of money printing and deficit spending. But that being said, today we're talking about why the market is continuing to move higher, despite the fact that we actually got bad news. Because a lot of people are looking at like the inflation numbers and they want to be like, oh, well, the inflation numbers looked a little bit better. And so that's why we should rally. But that's not exactly the truth of it here. So let me first pull up. This is retail sales. Okay. And this is what I'm talking about by bad news. Everyone wants to focus on within the casino. There's always this bias up and to the right, up and to the right, up and to the right. They're just looking for an excuse to get your money into the casino. Okay. Again, truer words have never been spoken in a fictitious environment than was the movie Wolf of Wall Street, with Matthew McConaughey talking about another brilliant idea so that we can keep your money and then add even more to it because we get fees and commissions every single time there's a transaction. That's all it is. Transactions, right? You'll even see during a down market, investment banks will still do well because their investment banking portion of their business is, unwinding trades and, putting money into other places. And so all of those transactions make them money as well. It's how they kind of hedge their business operations. And it's why they wanted to become bank holding companies, because during good times, they want to increase the amount of money that they're making by making loans and participating in that side of the economy. And then they want their cake and they want to eat it too. They also want to make money on the investment banking side during the up and the down markets, especially the down markets, because lots of people sell. They'll pay anything to get out, and you get a huge amount of fee income. Well, that bias to try and find something to the upside, everyone's focused on the CPI. This is what I'm looking at. Advanced monthly sales for retail and food services. Okay. Retail sales. This is basically consumerism in America, right? What's the health of it? All right. This is the actual report from censusbureau.gov. But what I'm going to do is I'm actually going to transition over to the Yahoo Finance article because they at least sum the numbers up. But again, you got to take this with a grain of sand. Like, you can't take their conclusions at face value because they're part of essentially the media complex that continues to feed this up into the right mentality, right? They're always going to look for the silver lining, so to speak, even in a bad situation. The title of their report is Retail Sales Flat in April. And by flat, they mean literally zero, no increase, okay? Which immediately makes me skeptical, because the moment there's no increase probably means that the number is going to be revised down in later months. And I'll show you why I feel that way. But the remainder of the title is Falling Short of Wall Street's Expectations. And yet the casino is rallying like crazy right now. I wonder why that is. Well, let's put the pieces together here. U.S. consumers showed signs of slowing. I'm putting air quotes. They use the word slowing. I'm putting air quotes around slowing. Slowing in April. Retail sales were flat in the month, according to data from the Commerce Department, furthering concerns about the state of the consumer amid sticky inflation and higher interest rates. This marked a slowdown from the 0.6% month-over-month increase in March. Now, here's something that you have to note, okay? I'm going to read a little bit further here, but I'm going to come back to the 0.6%. Economists had expected a 0.4% increase in spending. Now, here's what you got to focus on. First of all, they said this is a market slowdown from March. Well, March's number, and I don't even know, they might even reference it like later down in the article, right? They want to get you. They just want you to read the first couple of paragraphs. Things great. Put my money to work. Go buy Microsoft. Go buy Amazon or whatever, right? Well, that 0.6% last month is actually decreased. Now, they only decreased it by 0.1%, but guess what? That doesn't mean they can't decrease it more in the future, right? So their projections, and you got to remember, this isn't actual data. They use a little bit of data, and then they create all these extrapolated mathematical models to come up with these numbers. So they can fudge them any way they need to. That 0.6% last month when it was reported was actually 0.7, which is the reason why I'm saying that this report on April came in flat. It's entirely possible it's negative, okay, once they go through the corrective actions. And I've also said in the past, a lot of these economic numbers can change very quickly. The inflation rate can drop dramatically, okay? And it can drop dramatically within a month. And then also you can get revisions in the prior months that are also serious drops as well, okay? Same thing with unemployment numbers and job losses, okay? Job loss numbers can look really good until they don't look good, and they can look really bad in a hurry, okay? There's actually a story I'm not covering today, but in the irony of all ironies, the company Indeed that helps people find jobs is cutting people from working at Indeed. So if you needed any kind of anecdotal evidence about the health of the employment marketplace in the United States, go no further than the bitter irony of people who are trying to find other people jobs. They got their jobs cut. Okay. But so now looking at these numbers, these are not good numbers. All right. So why would the market be rallying? Like I said, a little bit of a lighter inflation number, and the combination of this bad news means that we are closer to the first Federal Reserve rate cut. And again, you can make the argument whether or not that actually has a positive impact on the economy, at least directly, or if not, it's just kind of, jawboning that eventually causes market sentiment to change, right? But I've said it in the past, I'll continue to say it. Typically, the worst economic performance, or not economic performance, the worst performance in the casino usually follows the first Federal Reserve rate cut. Okay. And that also typically follows this like relief rally, right? Air quotes, relief rally that you get when everyone's like, oh, thank God. Finally, the Federal Reserve is lightening up on monetary policy. It's going to solve everything immediately, right? Well, that causes a pop, and that's the last pop. And then we go down. All right. We could be in the middle of that right now. And in fact, if we watch some other indicators as well, we're going to have to look at whether or not that's the case. But here's what a lot of people on Wall Street, a lot of talking heads are hanging their hat on right now. They're hoping that this bad news is just bad enough to get the Federal Reserve to cut rates, but not bad enough to mean that we're in recession or worse. Okay? It's a very fine line, right? They're the great, they're Papa Walinda. They're out on the high wire, okay, with no net under them, and they're expecting that they're going to be able to balance, right, and not fall over to either side. All right? This is a very fine line that's being walked right here. And typically what happens is walking that fine line works until it doesn't. And when it doesn't work. When it doesn't work, it's like a catastrophe, right? Like it's not something that's just mild, right? It's usually something that's really bad. So the stock market thinks that we're going higher, and it thinks that this is news that's just bad enough to get the Fed to act. Well, let's check in on the consumer. We've done this in the past, but as we get updated numbers, let's see what's going on here. Credit card delinquency surge. This is a story out of The Hill, and it is dated today at about 10 o'clock this morning, Eastern time. Credit card delinquency surge. Almost 1 in 5 users, I don't even know why they use the word users, but almost 1 in 5 users maxed out via their research. Okay. What does maxed out mean? Well, we read further down here and we come to find out that there's the big disparity here. And we already know this exists. The wealthy are doing fine. They can make up the stagger with all of these market distortions that are happening. Everyone else is screwed, right? Like the economy is not working for, how do I phrase this? Every single day, the economy fails to help or work in a positive way for more and more people. So more and more people every single day get left behind and left behind and left behind. And this is the death of 1,000 paper cuts when you don't let actual economics work its magic. Okay. When you don't have the contraction that you've needed since 2008, more and more people get left behind every day, every day, every day. And they do more to kick the can, kick the can, kick the can, right? Until you get to the point where, God forbid, in bad enough cases, right now in Cuba, the banks are out of money. There's no cash. So what happens? Usually the pitchforks and the torches come out. All right. This is what, revolutions are based off of. This is why people call for things like socialism and Marxism, because they think it's a better alternative to what they have to deal with. All right. Every single day, this economy leaves more and more people behind. Well, there's a striated difference here between, say, the people that are in the best credit condition, that that's about like half of borrowers right now. And it was actually better before COVID. Half of borrowers right now are only using about like 20% or less. So think if you have $100 limit on your credit card, like half of people only have like $20 borrowed or less. All right. But there's 18% of people with credit cards out there that have used at least 90% of their credit limit. So you're talking about 18, and they use the roundup to 1/5. 1/5 of all of the people in our economy that is based off of buying services and consumerism, they have credit cards, and those credit cards are maxed the F out at a time period where interest rates are staying high, and at a time period where they can't just go to the bank and ask for a higher credit limit. And so they've used those credit cards to maintain a standard of living that is unsustainable in the current economic environment. All right. And it's being added to by the fact that there's a large, not huge portion, but a large portion of the population that continues to spend as if everything is fine. which keeps prices high. Okay. And again, a component of this is the money printing from 2021 and 2022, all right, and 2020. A component of it is that. But a lot of that money is still warehoused at corporations and in their balance sheets. What's really going on here is the prolonged effects of supply chain disruption and not allowing the economics of that situation to actually work itself out. And so you have 18% of people that are, if they're lucky to have a job right now, are living paycheck to paycheck because they don't have anything left on their credit cards in order to pay for daily expenses. So what happens when they lose their job? They're going to begin to default. We've already seen a huge increase in the amount of people that are now delinquent in terms of their payments on revolving credit lines like credit cards and auto loans. A quote from this is, in the first quarter of 2024, credit card and auto loan transition rates into serious delinquency continued to rise across all age groups. Now, young people are the most likely to have maxed out credit cards, and luckily enough, young people probably have like $500 limit or $1,000 limit on their credit card. But if they have a decent job, maybe they got $10,000 in credit card debt, okay, and they're maxed out. But this is showing that across all age groups, it's not even just one or the other. It's not just financial mismanagement by young, impetuous kids. It's economic lack of prosperity. And if it's actually the exact opposite of prosperity, it's people that are descending into this credit hellhole. I've written at length about how people need to cut down on their expenses, and they have to get away from variable rate debt, because these credit cards, even if the Federal Reserve does try to come to the rescue and cut interest rates and credit card interest rates come down, they're going to go back up again because the Fed is going to overreact. And the wave of inflation that we've seen, you ain't seen nothing yet. All right. You're going to see a wave of inflation like you've never seen before in your entire life if they continue to try and go down this road. Now, if all of a sudden they have this come to Jesus moment and they decide to actually let economics play out, then maybe you don't get the inflation. Maybe they cut interest rates a little bit. They accept the pain. They see the unemployment rate rise. They try and take the edge off a little bit, and they let some of these zombie companies that should have failed in 2008. And in fact, many of them are still left over from 2000 when we had the dot-com bubble burst. Maybe they'll actually let these companies fail. I'm not holding my breath about it, though. What I would anticipate is they're going to do the same thing that they always do. They're going to overreact with the money printer, and this go around, the money will actually be unleashed. The money will act like, I highly doubt that they're going to start up the money printer and all of a sudden you're going to see a ton of people just start to pay down their debt. People are going to continue to try and keep the lifestyle in which they've grown accustomed. Earlier today, George Gaiman from Rebel Capitalist tweeted out about kind of the disconnect that people have in terms of whether or not this kind of situation is sustainable. Okay. And he talked about how, and I think also someone else was tweeting about it as well, because we're talking about this retail sales issue and the CPI numbers. And I said, the first question we got to ask, like the deeper question that we have to ask, is whether or not the last 40 years of our living standard has been sustainable. Like, it's not just unsustainable now. Was it unsustainable back in the mid 80s and the early 90s when rates began the roller coaster ride down over the last 40 years? Well, all of the money printing and the perpetually artificially reduced interest rates answer that question. And the question is no. It wasn't sustainable based off of our own efforts, based off of our own economic activity. It was sustainable because we could steal from other people. We could export our inflation. We could buy lower and lower and lower priced goods as there was this competition, like this race to the bottom, because you had other countries that were trying to inflate their currency, like China, faster than we were inflating our currency. And so we were exporting our inflation to those areas. Well, that's flipped now. China's currency is appreciating. They can't stop that tide. Japan had been trying to stop their currency from inflating all along. They finally gave up. And so you're seeing a lot of these things unwind. And my concern is that the people that are in power don't appreciate, they think they are the gods of economics. They think that they can manipulate markets to their liking. And when the cost actually comes to bear, they will be powerless. They'll tell you, they'll take it to their grave that they were able to do things, and maybe they could have done things a little bit different and they could have fixed it. When eventually sometimes you just have to surrender to the actual natural law of economics. There are things you can't fight, no matter how big your money printer is, no matter how low you keep interest rates for how long. Can't do it. It's like, I mean, anyone right now, if you're trying to keep up your standard of living right now, right? Like, go watch 8 Mile. I'm not because I think it's a great movie. I mean, like, I think the end of the movie is funny. But just for the one line, or just watch the gif of Eminem, where he's like, you ever think that sometimes you got to stop living up here and start living down here, right? Like, sometimes you got to live in a realm of reality. The last 40 years have been a fever dream. And it's been a fever dream because people have manipulated the economics to an extent at which they can't manipulate it anymore. The economic cycle's like, nope, sorry. We gave you 40 years. We're going in the other direction now. There's going to be some boring stuff that's going to be the best investments. You're going to get 2-3% return on something. You're going to be happy about it. You're going to be pleased as punch to get 2 or 3%. In the past, you used to get 2 or 3%. And you're like, I'm not even keeping up with inflation. Well, guess what? In deflationary periods, if you're making 2 or 3%, you're doing pretty damn good, right? We'll see what happens, because they might try and turn the money printer on, in which case that deflationary pressure, they're going to try and fight it with everything that they can, and they'll cause a huge wave of inflation. But that huge wave of inflation will eventually crush itself. We'll see it play out. I'll be here with you. Don't worry. I'll hold your hand. Hopefully you're taking some advice, a little bit of advice, and getting more conservative. As you watch the stock market and the casino, let's pull this up right now. As you watch these things kind of like push higher on these kind of days where this news is not like amazing news, right? This is the S&P. We're putting in all-time highs. We're at all-time highs, people. Party. Woo! If you're the average Joe, you having a party right now? You think things are great? No. This is an illusion. This line right here, this line of demarcation, like, that's all an illusion. The further we go higher, this is all just dumb money piling in, right? This is all FOMOing. I mean, technically, if you want to be like really accurate here, let's go back to like 2008 and look at what this so-called recovery looks like. Okay, we fall in 2008 and then we start moving back up here. I would make the argument that probably from like 2011 on, like, this is all FOMO. All of this. FOMO, 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 FOMO. Oh, 2020. Oh, no. No, we'll just turn the money printer back on. FOMO, FOMO, FOMO. Then all of a sudden in 2022, we had a moment of sobriety. They closed the bar for like an hour, and the drunks rioted, and they opened the bar back up, and the party's back on, right? I mean, you could make the case that anything above this pullback, and again, I'm sorry, I have like 9 billion trend lines on my chart, but anything beyond this pullback right here, where we started to bounce, this is all just dumb money, hoping that the Federal Reserve can fix everything and make things better. That's all it is. And we're going to continue higher for this final rally, and we'll see how much money gets suckered in. We'll continue to see narratives like the GameStop narrative. You'll continue to see people get suckered into Bitcoin because they think they understand it, and you're stupid and you're too conservative. You like gold and silver. Bitcoin's going to the moon. Okay. When really at the end of the day, it's just Nvidia, just a different form of Nvidia. It'll have value over the long run, but more as a historical accounting of how Bitcoin and crypto came into existence. I doubt you will see large swaths of people using Bitcoin actively. I don't think you're going to see too many world governments doing their overnight clearing in Bitcoin and cryptocurrency, or at least not Bitcoin, maybe a different cryptocurrency. In fact, it'll probably be in CBDCs, which is another story we'll have to talk about in the future. But all this FOMOing right here, this is all just opium. It's all just, betting on whether or not the Federal Reserve can come to the rescue soon enough to stop the pain from happening. Well, unfortunately, some people need to come to the realization that the pain's inevitable. It's gonna hit, right? And we're on the precipice of it right now. The consumer is tapped, absolutely tapped. What else am I looking at here? Dollar's weak today. Again, Fed's gonna cut. Dollar's weakening. It's a good day. Weak dollar. Yay. Buy stocks. Yeah, okay, good luck. Volatility's down. Again, like I said, you could see a huge move down in volatility right here. Like volatility bottomed out. I think back in 2008, it bottomed out at like maybe, let's see, we'll go all the way back here. It was like at 9. Then again, in 2018. Look at this. This is something people don't remember. Okay. This is 2018. Look at the volatility index. I know this is messy, but look at the volatility index. This is 2018. People don't even remember this. They blotted it out of their memory. COVID has made it so that people don't even remember this happened. Look at this spike in volatility. Starting about, let's see, January of 2018, the VIX spiked to almost 50. Okay. Typically above 20, you're in like recessionville. You're in, bad economic times. The casino's getting torn apart. People completely forget that this happened. Okay. And I would make the argument that because this happened, what's happening now is going to be made worse because they didn't allow this to play out. All right. They also didn't allow 2020 to play out. VIX ripped. They came to the rescue. They didn't allow that to play. COVID actually could have been a positive thing economically. Like, believe it or not, the lockdowns actually could have allowed a lot of these companies to go out of business that need to go out of business. They don't deserve to be operating. But at the same time, we have a VIX at 12 and a half, 12.6. This thing could continue to get crushed. This thing could go down to 8, 7, right? Like complete complacency, right? Oh, we could do nothing wrong. The economy is going to continue to grow and do great things for everyone when they don't know anyone or haven't asked their friends. Like, is this economy working for you? In the comments, let me know. Is this economy working for you? Are you improving your standard of living right now, or are you having to cut back? Oil actually caught a little bit of a bid. UK oil's down, but oil caught a little of a bid. There's actually a drawdown today. But it's not because people are using a ton more oil or a ton more gas. It's because supplies, how much activity, pulling the oil out of the earth and refining it is staying flat. And that means any small little uptick or even just regular consumption of oil is going to cause drawdowns in the supply, which now means that oil could also begin to rise again, despite the fact that it's not because economic activity is picking up. It could rise just out of a psychological effect of, Fed's going to cut rates. We're going to front run this oil, this oil move. And if that oil ends up spiking, that could kick off the Great Financial Crisis. The Great Financial Crisis, I'm going to call it 3.0, okay? Because 2018 should have been 2.0. But Great Financial Crisis 3.0, again, there's likely characters we could look at kicking this thing off. Oil is one of those. If the Fed cuts and oil goes to 100 or 120 a barrel, that right there, consumers going to just get absolutely obliterated at, 90, 100, $120 a barrel oil. The other thing that could happen would be bank failures and continued bank failures. Would not surprise me if we get more and more and more bank failures I mean, we're already seeing them around the world. Okay. And it's not like we're completely immune from that stuff. We're suffering the same slings and arrows that everyone else is. What else is happening in commoditiesville? Lumber, after that big pop in lumber, still seeing sell off. I mean, this could end up being what like traders call an island reversal, right? Like, or a I mean, it's basically a pump and dump, right? Like, uh, the other thing that you could end up calling it is a gap and crap, right? Like where you gap up, there's no trading in the middle here, and then it just comes all the way back down again. We'll have to see what happens with lumber. But again, not a good sign for the economy. Even with that 1 day pop, it's continuing to trend lower. It's not showing you that the trend is up just yet. It just had a good day. Gold and silver, man. Let's freaking go. Gold's pushing higher. Again, this isn't in anticipation of inflation. We got cooling inflation numbers. Why would gold go up if it's an inflation hedge? Gold's going up because of the consumer spending numbers. Gold investors are fearful of what's coming economically. Silver investors, a little bit of that, but silver investors are trying to front run the obvious wave of liquidity, tsunami of liquidity. What was a tsunami in 2020? We'll see what it is, what moniker they come up with it. A tidal wave. I don't know. The liquidity that's going to be coming from the Federal Reserve as we enter into this economic recession / maybe great financial crisis 3.0. Silver's ripping, man. Absolutely ripping. I bought some last month. I'm going to buy a little bit more. Like I said, I'm moving money into Kinesis so I can test out these gold and silver backed cryptos. I'm not putting a huge amount of money there. I want to test them through this poor economic environment. How does it perform? Do the cryptos actually hold up? From what I can see, all the public information is the only way that they mint new crypto is if more physical gold and silver makes its way into their vaults. And they have a diversified custodianship where it's like 4 or 5 vaults around the world where they hold it too. So, I mean, we'll see what happens with it. I'm testing it out, but I'm going further into the gold and silver, specifically more so silver. The gold and silver ratio is beginning to drop. Okay. I actually saw a video by Silver Seeker. I believe he put it out yesterday or the day before, where he went to a coin shop and he was asking coin dealers, like, would you buy gold or silver here? And most all of them are advocating silver because of the gold and silver ratio. Now, something also that came up during that was one of the dealers was basically saying, oh, well, I think of gold as a shorter term investment and silver as a longer term investment. And part of the reason being because of how manipulated the silver market is as compared to the gold market. The manipulation in the silver market means that overvaluation every single day, undervaluation of silver just grows and grows and grows and grows. And so eventually one day that will correct. And so for them, they look at silver as a longer term investment versus gold. They also look at this ratio and they say anything that's over basically 82 is like a screaming buy for silver. Anything that's under 82, it then begins to shift towards purchasing gold. We might get to the point where purchasing gold makes sense again, but this is still moving. I mean, like historically, it's like 60 is the ratio. 60x the gold price versus the silver price. That being said, I don't think we're going to get down there. We might get down to this like 76 level in terms of that ratio. Anything below like that kind of like 80 to 78 level, I think I'm actually probably not even going to be adding to the stack. I'll be looking for excuses to liquidate. I think if gold hits 2,500, I'm probably taking some pieces off of my physical stack, and I might even either shift it into silver or just sit on cash, waiting for an opportunity to get back into something else like gold and silver or another investment that's out there. But gold and silver are performing extremely well today, and it's not because people are anticipating good economic activity moving forward. Keep in mind that there are certain investments in the marketplace that are slow and boring and rational. Gold and silver, specifically gold, is typically one of those markets. Okay. The other one would be, say, like the 10-year treasury market, right? Like that market's fairly rational. The boring stuff is usually what moves slowly and doesn't typically overreact, or when it does overreact, it doesn't do it to the same extent that some of these other portions of the casino do. But yeah, that's what I'm looking at commodity wise. I'm not seeing anything else, earth shattering as far as commodities goes. Let's look at fixed income really quickly. High yield bonds are up again, risk on. We're right at that resistance line again. Okay. A break above this, it could entirely be a sucker's rally. Okay. But if it does break above this line of resistance, it's risk on. We'll continue to see new highs in the casino until it doesn't work anymore, until economic reality finally hits everyone. And as opposed to that Federal Reserve hopium, the actual economic numbers take over. And then we see that reversal and it fall over. It could freeze right here. Who knows? But something has to happen. There has to be there's got to be a spark. Okay. The tinder's dry. It's drenched in kerosene right now. But there has to be a spark to light off this economic situation that we're coming into. Could be war. I mean, that's another example. Huge oil prices, just from kind of commodities speculation. It could also be war that then creates increases in the price of oil and gas. Or you could also be looking at financial illiquidity in the system, which we're seeing in other places now too. Here's the other thing. People are buying U.S. treasuries like crazy. Why? They're anticipating rate cuts. Okay. And you could say it's because they're anticipating rate cuts, or consciously or subconsciously, it could be because they're anticipating an economic downturn, which we've technically already been in for an extended period of time. But now what's also interesting is the 5 and 10 year looks like it's being bought up a little bit more than the 2 year is. So this is also kind of a strange situation where you're actually seeing the inversion between the 2 year and the 10 year widen, despite the fact that people are buying U.S. treasuries. So we'll have to see how this resolves itself. Either the 10-year yield or the price of the 10-year bond is getting ahead of itself, or the 2-year bond price is lagging and will eventually catch up. Okay. But looking at the 2-year yield, this is people anticipating that there's going to be a Fed rate cut coming pretty soon, by the way. All right, let's get out of the casino. We'll talk about cryptos really quickly. Again, we were looking at Bitcoin. Bitcoin's still in this consolidation range, and it's still drawing down, even though it's having a really nice pop today. We'll see. We're right at this kind of like resistance line sitting over the top of it. It's actually at the bottom end of the narrower consolidation range we were looking at way back when at 64,900. So we'll see how it plays out with that level here over the next couple of days, especially when it comes, when it relates to the rest of the news flow. Bitcoin is leading the market. So total crypto market cap is up less than Bitcoin is on a percentage basis right now. As a result of it, Bitcoin dominance is up, meaning Bitcoin is a bigger portion of the crypto marketplace than it was yesterday. And so that just means that Bitcoin is moving more dramatically, I'll call it, than the rest of the crypto space. Again, because Bitcoin's up considerably, you're seeing a lot of other cryptos move considerably as well. Solana, nice little pop today, 7%. Avalanche, nice little pop today, 7%. Again, notice the trend here. It's down. We're getting a little bit of a pop. This does not create a trend. Okay? It's a trend for the day. It's not necessarily a trend for the week or the month or the year. So we're going to have to continue watching this to see whether or not there's any follow through. We're also seeing a lot of the micro caps move positive as well, but again, they're lagging Bitcoin and the rest of the market. So you're seeing some of these micro caps. Oh, huge news. My Dimo miner got shipped today. So I will be able to dual mine Sorchain as well as Dymo. I believe it's Dymo, but it could be Demo. I will be able to dual mine those now. And that's 2 of the 3 miners that will be in the car. So I'm just waiting for the Honey miner that has been back ordered for a long time. And in fact, they're coming out with a brand new device, and that's the one I ordered. So that might be a little bit longer in the making. But the Demo miner is coming, and so I will do a write-up on that like I did on the Sorchain miner on the Anarchist Investor Substack. So reminder, get on the Substack for free. anarchistinvestor.substack.com subscribe for free. And you also get in on the drawing on June 3rd. June 3rd, I'll be giving away 4 annual paid memberships. And I'm actually working on a Excel dashboard for portfolio tracking. And that Excel dashboard will then be the basis for how the model portfolio will be reportable and digestible. And I will make that available to everyone. Even if you're a free subscriber, you'll get an opportunity to get that dashboard. You won't necessarily get my updates on the actual portfolio itself, but I will make that available to everyone for free. So it's another reason to get on and sub for free at anarchistinvestor.substack.com. Yeah, that's all I'm really looking at. I mean, crypto's up, so it's a decent day today. Like I said, I got lucky. I got a nice little pop here once I had to move my crypto into Bitcoin in order to move it over to Kinesis. So made a couple of extra shekels today, which is nice. And I'm just continuing to look at a lot of this stuff going forward. Again, the hopium is real right now. The question is whether or not there's actually any follow through in the market, and whether or not that follow through is based off of hopes and dreams, or whether or not it's based off of actual economic data. My anticipation is we'll continue to see the economic data weaken because the consumers they're done, man. They're tapped out. They're throwing in the towel. And in fact, I would say a lot of them, based off of that credit card utilization data, they're not even throwing in the towel because they want to. They're throwing in the towel because they have to. So we'll see how that plays out. Actually, another good channel to watch before I hit the outro here. Another good channel to watch is a guy who it's called Car Questions Answered, CQA, Car Questions Answered. This guy's a small used car seller, but he has his finger on the pulse of the repossession market because he goes to all the auctions, all the auto auctions. There's a lot of repossessions happening right now, and every single one of those repossessions is a write down in an auto loan that went bad. And the banks, you haven't seen it show up in their financials yet. Keyword being yet. So I would head over to Car Questions Answered and check out his channel and throw him a sub if you get some good information out of those videos the way I get some good information. It's really good anecdotally as well. And I think he also has a team of people out there that are creators that are sharing data with him like once a week or once every couple of weeks. They do kind of like a combined video as well, which is great because you get your finger on the pulse of, not just the auto market, but also real estate and a couple of other things. So with that, we made it to the end of it. It's the end of hump day, people, or at least we're towards the end of hump day. You've made it halfway, so we can get to the end of the week together. I will be back here live at noon tomorrow, Thursday, noon Eastern, that is. And I'm looking forward to it. Thank you so much. I appreciate all your time, energy, and attention. And with that, I'm going to hit the outro. Peace.
Stuck in a system that just ain't right. Gonna tear it down. Gonna start a fight. Anarchy and numbers is my game. I'm the investor with no shame. Greed and corruption, that's the name of the game they play. It's all a shame. I won't play by their rules. I won't comply. Anarchy's the way. It's time to fly. show with my rebellious spirit. Watch me grow.